Did you know mortgage is related to death? The word mortgage stems from the old French word mortgage or mortgage, which means dead pledge. This is because your mortgage dies once you pay it off or fail to make payments. For many, owning a home is a huge dream, and for most people who can't pay the full cost of a home out of their pockets, getting a mortgage is just one of the steps to getting there. While most of us have certainly heard of a mortgage, some don't even know what it truly means in the process of acquiring one. So in today's video, that's exactly what I'm going to talk about and explain to you. So first and foremost, we need to know the definition of a mortgage loan and what makes it different from the other loan. Well, a mortgage is a type of loan offered by banks and other financial institutions to purchase or maintain a home, land, or other types of real estate. Think of it this way: unlike loans where you get a sum of money and agree to pay the money back, a mortgage loan is for simply buying or maintaining a house and nothing else. A mortgage is a secured loan, meaning the borrower promises collateral. In our case, the collateral is the home to the lender if they stop making payments. The lender has rights to the home until the mortgage loans have fully paid. So if you stop making payments on your mortgage, your lender can take possession of your home in a process known as foreclosure. Collateral simply means something provided to a lender as a guarantee of repayment. So how does a mortgage loan work? To get started, most banks will require a down payment of 20% of the value of the property, but in some cases, a down payment can be as low as 5% of the value of the property. In some rare cases, you don't even have to pay the down payment, but that just means you will have unfavorable conditions on the loan. Down payments are the biggest upfront expense when buying a home. The down payment you make on the house impacts what kind of mortgage you qualify for, how much a lender will give you, and the loan's terms and conditions. Generally, if you put less money down on a home at closing, you'll pay more in fees and interest over the mortgage loan's lifetime and vice versa. A large down payment will give you a lower loan-to-value ratio or LTV, but we'll get to that later. This key measure makes you less risky to lenders and may qualify you for lower interest. But remember, too much down payment could affect your financial health in the long term, so it depends on how much you're comfortable paying. The borrower makes regular payments of the loan plus interest over a specified number of years until the loan is fully paid and the property becomes their own. As stated earlier, should the borrower neglect their promise to the borrower of monthly payment of the property, the lender has every right to evict the residence, sell the property, and use the money from the sale to pay off the mortgage debt. So, do you see a red door anywhere? Did you know that in Scotland, people paint the front door of their house red once they've finally paid off the mortgage to show off their accomplishments? So who provides mortgage loans? Mortgage loans are often made by banks and other traditional financial institutions, but not always. Life insurance companies, pension funds, and other large asset management firms also have mortgage lending arms. Mortgage loans tend to represent very stable and consistent sources of future cash flows by way of the borrower's monthly payments. Mortgages are also issued by other private investors. These parties pool funds into various forms of mortgage trusts to create private lending entities. These funds are often deployed to homebuyers and real estate investors by way of mortgage brokerage companies. A mortgage broker is not a direct lender. A borrower will generally enlist the services of a mortgage broker to help them shop around to all the previously noted mortgage lenders to secure the best rate and terms for their borrower. The broker is typically paid by the lender that closes the deal. Types of mortgages. The two basic types of amortized loans are the fixed-rate mortgage and adjustable-rate mortgage, also known as a floating rate. In some countries, fixed-rate mortgages are common, but floating-rate mortgages are relatively common. Combinations of fixed and floating-rate mortgages are also common, whereby a mortgage loan will have a fixed rate for some period, for example, the first 5 years, and vary after the end of that period. In a fixed-rate mortgage, the interest rate and monthly payments stay the same for the duration of the loan. In an adjustable-rate mortgage, the interest rate is generally fixed for some time, after which it will periodically adjust up or down depending on market conditions. The process. So let's bring Bob into the picture. Bob is a hard-working man and is in dire need of a home for himself and his lovely wife Wendy. So what does he do to make his dream come true? He will have to go to the lender, let's say a bank. Bob will approach the bank to purchase a home. The bank will ask for financial documents as proof that he is capable of repaying the loan. The main considerations for Bob's mortgage approval are income, credit score, and down payment amount. And of course, Bob's financial documents will have to be verified by the mortgage loan underwriter. The process usually takes a few days to a few weeks. This step is to get Bob a mortgage that's best for him. Bob will then be required to make a down payment, and Bob makes, let us say, a down payment of 10% because the bank is considerate. But paying a low down payment means that Bob will pay more in fees and interest over the mortgage loan's lifetime. Before Bob approached the bank, he had already found his dream home, which cost $300,000. So the amount Bob paid as a down payment is $30,000, and the mortgage amount will be $270,000, representing a 90% loan-to-value, or LVT. This is a pretty high LVT, which will mean Bob will have less favorable loan terms and conditions, like being required to buy private mortgage insurance, which is designed to protect the bank from any default by the borrower, unlike the 20% down payment that most lenders ask for, which usually have favorable terms and conditions and won't be required to acquire the private mortgage insurance, which is commonly used in loans with an LVT of over 80% and employed in the event of foreclosure. That's why it's ideal to pay a down payment of 20% and above. LVT equals 100% minus down payment percentage. So in this case, Bob's LVT will be 90%. The bank will then register a security charge, or is simply referred to as lien, over the property for the full amount of credit outstanding, in this case, $270,000. This security registration makes the property collateral for the mortgage loan. Bob won't receive the actual cash from the bank. He will make the down payment to the bank, which will facilitate the home purchase for him. This diagram shows you how the process works. Step 1. Bob approaches the bank and makes a down payment of $30,000, which is the 10% down payment. In Step 2, the bank puts together the amount Bob paid as a down payment and the money they are lending Bob, which is $270,000, and works with various legal representatives to ensure that the title of the property is correctly transferred from the property seller to Bob, and ensure that the security charge or lien is registered on behalf of Bob's bank. In Step 3, the property owner's bank receives the money from Bob's bank, which will in turn transfer the money to the owner in Step 4. After receiving the full payment from the bank, the seller will now be required to give Bob the property's title in Step 5. After this process has been finalized, Bob will now be the proud owner of the house. But until Bob finishes paying the house, the bank can still take ownership of the property and sell it to pay the debt Bob owes them, if the unfortunate happens and Bob fails to complete the payment of the mortgage. After Bob gets the property under his name, he will then be required to pay the $270,000 back plus interest to the bank that lent him the money. The mortgage payment is in two forms: the principal, which is the $270,000 the bank lends Bob, and interest, which is generally fixed or floating considering which type of mortgage Bob took. Fixed interest tends to offer predictable payments, which will make budgeting for Bob easier, but tends to be expensive in the long run as compared to the floating interest, which tends to change based on the market, which means it can give you access to very low interest rates. So let's say Bob took a 20-year fixed-rate mortgage with a 4.5% interest rate. Bob will be making a monthly payment of $1,708.15 for 20 years. This means Bob will clear his debt in October 2042 if he had taken the loan in November 2022. Some websites make these calculations very easy. The link to the website I'm using is in the description below, and you can check it out. In loan amount part is the amount the bank lent Bob, which is $270,000, and the interest rate part is the percentage of interest Bob agreed with the bank, which is 4.5%. And the term is just the number of years you have to complete the debt, which in Bob's case is 20 years. After entering the details, just click calculate. And the most interesting part about all this is the fact that during Bob's early stages of the payments, it's that he is going to pay more interest than principal, and as you go down after a couple of years, the principal surpasses the interest. In the beginning, Bob owed more interest to the bank because his loan balance is still high. So most of his monthly payment goes to pay the interest, and a little bit goes to paying off the principal. Over time, as Bob pays down the principal, he will owe less interest each month because his loan balance is lower. So, more of his monthly payment goes to paying down the principal. Near the end of the loan, Bob owes much less interest, and most of his payment goes to pay off the last of the principal. This process is known as amortization. Just think of it this way: the more money you owe the bank, the more interest you have to pay, and vice versa. With a typical fixed-rate loan, the combined principal and interest payment will not change over the life of your loan, but the amounts that go to principal rather than interest will. That's it for this video. I hope you've learned something valuable. If you liked the video, please make sure to hit the like button and subscribe for more contents like this. Thanks for watching, and see you next time. Peace be with you.